Good day and welcome to our webinar for April 2025. We begin as usual in America, and you'll see on the screen there the S&P 500. Obviously, the New York Stock Exchange is being hammered by Trump's on-again, off-again trade war and tariffs. I think to investors it seems that every week there are new tariffs and there's no clear policy and the future direction is very uncertain. This uncertainty is now combined with bad news on core inflation, and the latest tariff is 25% on all vehicles being brought into the United States. Of course, today is April the 2nd, so that's the big day for Trump, his so-called Liberation Day, when he's going to tell us what all the tariffs are. The S&P 500, as you can see from the chart in front of you, is back down to that 10% below its record high. The record high was 6144, as you'll see on the chart there, on the 19th of February. So we're 10% below that level. That correction of 10% is entirely caused by Trump. And that is despite the fact that the underlying sentiment, in our view, remains bullish. The main problem, of course, is that his stance on tariffs is constantly changing. He's now talking about imposing a 25% tariff on Russian oil coming into America from Russia. The problem with that, of course, is that America does not actually import any oil from Russia, so I'm not quite sure what that's about. But investors just seem to get a handle on the tariffs and then he changes them again. Without Trump's trade war and the tariffs, in our opinion, the S&P 500 would be breaking new record highs. Nobody seems to know what he will do next, probably not even himself. The bad inflation figures which were published on Friday may cause the Fed to become more hawkish. Powell has said that the sort of blip in inflation is transitory, but the market doesn't really believe that. They're worried about a more hawkish stance on interest rates. And if you add that to Trump's tariffs, this has taken the S&P back to its key support level. Now, we tweeted on the 11th of April that, in our view, the 5550 level on the S&P 500 was a buying opportunity. We tweeted that on the 11th, and so far that position has held quite well. That 5550 level has been tested a number of times in the ensuing days, but not significantly broken. And we remain confident that that is the level that the market will turn on. It certainly looks like that at this stage. So again, we reiterate that it was a buying opportunity. Of course, inflation came through in the form of the Personal Consumption Expenditure Index, the PCE, and that was 2.8% in February, just slightly above what economists were predicting at 2.7%. But it shows that inflation is being stubborn in America. And of course, we all know that tariffs will add to inflation there. In addition, the jobs number came out for February month, and that showed that there were 151,000 jobs created in the American economy in February. That was less than the 170,000 jobs that economists were expecting, but still showing good growth. The unemployment rate came in at 4.1%, and that's still very close to what economists regard as full employment. Growth has definitely slowed somewhat, but we believe that this is a soft landing, which is exactly what the Fed wanted. Provided, of course, that Trump doesn't mess it up, and we can't be sure of that. There's nothing sure on that score. And another thing that's important is that despite the cuts which Elon Musk's Department of Government Efficiency has made, the government deficit for 2024 was $1.8 trillion. And in the first 4 months of the 2025 year, it has surged to $840 billion. So the debt ceiling will probably be passed sometime between July and October this year. And obviously that will require a revision of that debt ceiling. But it's clear that the government debt in America is rapidly growing, and it's approaching $37 trillion. The interest on the 2024 debt was $950 billion, which for the first time was more than America's defense spending of $826 billion. It's also worth noting that America's defense spending is more than 70% of the total defense spending of NATO. That's just a side note there. So, there's been a rapid shift in investor sentiment towards risk on, and this can be seen in 2 other charts which I'd like to share with you. The first one is the Rand. Sorry, I'm battling a little bit here. Right. Okay, here's the Rand chart. I'm going to just take it down a little bit. Right there you can see the Rand. Sorry, I'm working on 2 screens for the first time, so I'm a little bit confused, being technically challenged at my great age of 72. Of course, the Rand is the emerging market currency of choice amongst international investors. This is because it has very high volumes in a very well managed and highly liquid market. So it has responded to Trump's announcement of the 25% tariffs on all vehicle imports. Overseas investors quickly withdrew funds from emerging markets, and the Rand fell back immediately to 1840. And you can see that here on the chart there. That's where it fell back to 1840 in this area here. But as you can see, this brings it into line with its strengthening trend line. All right. You can see on the left-hand side of the chart, this is the period when Trump won the election, and that caused the Rand to weaken to a peak level of 1914, which it reached on the 10th of January. And that since then we've had a strengthening pattern, and that this spike up to 1840 doesn't break that strengthening pattern. So we expect the Rand to continue to strengthen. That's basically what I'm saying. The risk-off sentiment in the American markets is already turning around, and I think that we'll see the Rand getting stronger now. The other chart that shows this shift towards risk-on is the gold price. I don't know if you've been following the gold price, but here it is. I just want to put a bit more data on. You may recall that in our confidential report of March 2024, which was published over here, I think about there, yes. Sorry, that red arrow needs to go across, but it was published here. And at that time, we reported that this resistance level at $2,060 had been broken, and that we expected a new upward trend in gold. And as you can see, that upward trend has manifested very strongly in the following months. And in fact, over the last year, gold has increased by about 50% in US dollar terms. And it's reached here an all-time record high, closing record high of $3,115. So it's up more than 50% from when we gave that warning in March 2024. Of course, gold, the demand for gold is mostly in the form of Reserve Bank purchases of gold as a reserve currency. So it does have some industrial applications, and obviously there's some offtake for jewelry, but the major demand for gold comes from the reserve banks, which like to hold a stock of gold as a reserve asset. Because gold has retained its purchasing power throughout human history. 1 ounce of gold today will buy you the same number of chickens or cattle or whatever as it would have bought you 5,000 years ago in Egypt. The purchasing power of gold has virtually not changed throughout human history. And that's through all the wars and famines and plagues and other disruptions of human activity. It's held on to its value. It is the most secure of all assets, and therefore its return is the lowest. It pays a zero return. It does not pay any dividends, interest or rent, and it doesn't add 10% to its weight every year. But it is eminently transportable, and it is accepted throughout the world. In times of political and financial crisis, the price of gold tends to rise because investors are willing to forego a return in order to have security. Smart investors know that no matter what happens, their money will be safe in gold. So when there's a threat of war or financial turmoil, they buy gold. And that is what we have been seeing here. Obviously, the rise in gold is partly due to the wars in the Middle East and in Ukraine, which have raised the possibility of World War III, and that always makes investors feel a little nervous. But it's also due to the fact that equity markets around the world are relatively high right now. Our advice to South African investors has always been hold about 10% of your total wealth in Krugerrands. Because you can put those Krugerrands into your wallet and take them overseas and sell them in any country in the world for more or less what you paid for them or what the current price of gold is at the time. So they're infinitely transportable, they're universally accepted, and Krugerrands are known throughout the world. There are more Krugerrands in circulation in the world than all the other gold coins of all the other countries, like the American Eagle and the Canadian Maple Leaf and all those. But we don't advise you to hold more than 10% of your wealth in Krugerrands, because gold obviously pays no return. So most of your capital should be invested in assets which pay a return. All right, so let's move on now. Ukraine. Obviously, Trump has had his impact there as well. His decision to cut Ukraine off from US aid and intelligence basically pressurized Zelensky to accept his ceasefire terms, which Zelensky did. But it clearly showed at the same time that Trump is supporting Putin. And Putin, of course, encouraged by this, has either rejected or broken all subsequent ceasefires. One of the positive impacts of this is that Europe and its allies are desperately now trying to fill the gap left by America. And this has taken various forms. Europe gave Ukraine 800 billion euros recently to support it. The UK has ordered 5,000 lightweight missiles to be sent to Ukraine. They're being produced by a company in Belfast, which has had to triple its output to meet this order. Canada is sending 80,000 Cold War rockets to Ukraine. They are rockets which are out of date, and obviously the Ukrainians will, being innovative and using their initiative, will find ways to turn those to good account. Australia has been supplying Ukraine with its Slinger system. It's a counter-drone system, which is very, very effective. And so there's quite a lot of support coming through from Europe and other non-European countries which support Ukraine. At the same time, Russia has been more aggressive recently. It's recaptured about 90% of the Kursk region, which was taken by Ukraine a while back. And this is obviously because Putin wants to be in the best possible position when it comes to negotiations. Several European countries have been talking about sending peacekeeping troops into Ukraine, something which Putin is clearly against. but it's an interesting fact that NATO countries together have a standing army, a professional standing army of about 2 million men. So even if they send in a small fraction of that, it will make a big difference to the Ukrainians. We believe that NATO will sooner or later put troops on the ground in Ukraine. I think it's inevitable. The UK's coalition of the willing is gathering momentum now. There are 31 countries involved. But we still believe that these countries will start to commit troops pretty soon. And those troops can be used to relieve Ukrainian troops, for example, along the Belarus border. And the relieved Ukrainian troops can then be used elsewhere. This would basically give Kiev more troops to prosecute the war. In 2024, Ukraine produced 1.2 million drones. And they've been using those with great effect. This year, they are aiming to produce 4 million drones. That will make it very difficult for Russia to continue with this war because anything that moves will be immediately targeted. Ukraine has also developed an acoustic system to track Russian drones, which shows their level of innovation and their technical superiority. At the same time that all this is going on, the Russian economy is taking enormous strain. Food inflation has surged to 70% this year. Potatoes are up 73%, butter is up 30%. The true inflation figure in America is much higher than in Russia is much higher than the official 28%. It's estimated to be 71.4%. Consumers are taking huge strain. Also, interest rates are 21%, and the opposition to Putin is growing. In our view, it's inevitable that he will be replaced sooner or later. All right, let's turn our attention now to South Africa and start on the political front. Particularly, we are all obviously concerned about the American Growth and Opportunity Act, and we believe that it will be replaced by bilateral agreements with each country involved, and South Africa will most probably then lose some or all of its tax-free opportunities in America. The motor industry will be the worst affected. Of course, this AGOA, this African Growth and Opportunity Act, allows members to export products to America duty-free. About 1,800 products are exported to America under this act. And as far as South Africa is concerned, this accounts for about 3% of our total exports. South Africa is also seen as an important sort of channeling country through which other African countries can export and import. If we're excluded from AGOA, it's quite probable that China will fill the gap left by America. One thing that's happened recently is very negative for us, and that's the appointment of Brent Bozell III as the U.S. ambassador to South Africa. He has proclaimed that he is a proud member of the coalition against ANC terrorism. So this is an extremely right-wing individual and probably not the best selection for our U.S. ambassador. On another subject now, the Minister of Health, Aaron Motsoaledi, has published the rules for the National Health Insurance Act, ignoring all the suggestions put forward by various parties. The NHI is already subject to 4 separate legal actions, and this tends to show that the ANC still thinks it's in complete control of the country. The ANC has also not said how the NHI will be funded. It was obviously hurriedly signed into law by Ramaphosa just before the election as an attempt to get more popular support for the ANC. But as it stands, it is completely unworkable and could result in a collapse of the medical industry in this country. All right, of course, obviously the ANC and DA are locked in negotiations over the budget, the revised budget, and we believe that they are now very close to an agreement, which we'll probably find out later today. We certainly think VAT will be increased by 0.5% this year, and there's a possibility of a second 0.5% increase next year, depending on what savings could be made in government expenditure during the year. But the agreement does show, once it's negotiated, this agreement will show that the government of national unity can work if the parties are prepared to compromise. The process of reaching a compromise will instill confidence in the GNU and in South Africa for overseas investors. A review of the budget has revealed that there's at least 12 billion rand of underperforming projects which could be either scaled down or cancelled. In 2021 and 2022, the Treasury found 40 billion rand worth of potential savings in government. If these had been acted on, there would probably have been no need to increase VAT. The decision by the government to pay ArcelorMittal's wage bill is, in our view, incorrect. By doing this, the government is interfering in the free market in this country. It is propping up a loss-making business at taxpayers' expense. If ArcelorMittal cannot make steel cheaply enough to compete with importers, then it should go out of business, even if that means job losses. All right, let's look at the economy more broadly now. Inflation was up 3.2% in the year to the end of February, which is the same level as it was in January, but it was 0.9% in the February month, mainly due to higher food and fuel prices. Core inflation is sitting at 3.4% for the year and was 1.1% in the month of February. Fuel prices, of course, went up 82 cents a litre, and food was up 2.8%. Cereals were up 3.9%, and fruit was up 6.8%. The maize index jumped 10.6%, and SAMP was up 18.7%. This is, of course, due to the midsummer drought that we experienced late last year, when there was no rain just before Christmas. So it is to be expected. Inflation for the whole year, for the whole of this year, is expected to be around 4.3%, which gives the Monetary Policy Committee quite a lot of room to reduce interest rates further. PricewaterhouseCoopers has said that they think the government's assumption about growth in 2025 is optimistic. The government is predicting growth of 1.8% this year. PwC says it will be closer to 1.1%. If they are right, then tax revenue will obviously be lower. Could be as much as 18 billion rand shortfall there. This will make the GNU's revised budget incorrect straight away. We believe that PwC is probably being a bit conservative, but there still could be a shortfall by the end of the year. Gross domestic product in South Africa grew by 0.6% in the fourth quarter last year, up from the third quarter's decline of so it was minus 0.1% in the third quarter, but it was up 0.6% in the fourth quarter. Manufacturing contracted by 0.6% and mining was down by 0.2%. Household expenditure was up 1% and government expenditure was down by 0.8%. The third quarter contraction again was caused by that midsummer drought because agricultural production fell by 19.7% in the quarter. In the fourth quarter, agricultural production, far from falling, went up by 17.2%. So that was a massive turnaround there. BankServe has come out with its average nominal take-home pay figure, and in February that was 18,241 Rand. That was the average take-home pay for South African salary earners. This was slightly higher than January's 18,141, but a hell of a lot better than February last year, which was 15,983. If you take the effect of inflation out of this, then people's real income increased by 10.7%. That's pretty big, and that was on top of January's 12.8%. So this shows the huge benefit that consumers are getting from the lower inflation rate. Obviously, the 0.5% VAT increase at the end of this month is a negative, as is bracket creep, which seems to be still in the budget. Most large mining houses, however, are increasing wages on average by 6% per annum, and the average nominal salary in South Africa is up 5.3% over 2024, which is 1.7% above inflation. So this means that people's real income is actually increasing in South Africa. And that's caused retail spending to rise by 5.9% in the 4 months to the end of January. Retail sales were up by 7% in the year to the end of January, and this is well ahead of economists' forecasts. Consumer confidence is up due to lower interest rates and low inflation. The two-pot system, retirement system, has released about 47 billion rand into the economy, and we expect the economy to improve steadily, provided there is no more load shedding and the GNU remains in place, which we believe it will. Sales of fast-moving consumer goods increased by 3.4% in 2024, and branded goods sales were up 7%. Consumers were still under some strain and focused on essentials, mainly on essentials. Despite this, Black Friday sales were up 7% on last year. Manufacturing production was down 3.1% in the year to end January. That follows a 1.2% decline in December. Chemicals, petrol, plastics, and rubber fell 9%. Food and beverages were down 3.2%. Motor vehicles, parts, and accessories were down 10%. Obviously, the rail and port logistics continue to be a problem. Manufacturing production must increase in order to create more jobs, and the Government of National Unity must find common ground to allow those reforms to continue. Okay, Standard & Poor's Purchasing Managers Index went to 49 in February, so that's considerably better than January's 47.4, but still shows that manufacturing is shrinking in this country. Local demand remains weak and exports were down due to the unrest in Mozambique. There's also considerable uncertainty about Trump's trade war and the tariffs which might be applied to South Africa. Business conditions have improved, though, with the end of load shedding and also with the appointment of the GNU and falling interest rates. The Reserve Bank's leading index has been moving up, and that shows this. The European Union has announced a 94 billion rand aid package for South Africa to compensate for America's withdrawal from giving us aid. This was announced at the G20 meeting, which was held in South Africa under President Ramaphosa's stewardship, and which, of course, the Americans shunned. South Africa is Europe's largest trading partner in Africa, with 100 billion rands worth of trade per annum, and South Africa's trade with the European Union is up 42% since 2016. The EU also accounts for about half of South Africa's foreign direct investment, so that's also important. America's isolationist policies are forcing other countries to find new trading partners. So closer ties with the European Union can only be good for this country. Okay, capital expenditure in the mining sector has fallen by 4% it's fallen in the fourth quarter of 2024, down by 9.6%. So it's virtually not there. PGMs, platinum group metals, have been the worst hit, with Northam Platinum reducing its capex by 25% and Impala by 58%. Mineral exploration in South Africa has basically stopped happening. There's been no mineral exploration in this country to speak of for the last 5 years, and that means that the mining industry will start to shrink. And of course that will reduce gross domestic product in due course. Okay, Transnet has reached an agreement with the South African Union, the Transport and Allied Workers Union, SATAWU, for a 6% increase for this year and next year. This is almost double the current consumer price index. And you must remember, while you're thinking about this, that Transnet made a loss of 2.2 billion rand in the 6 months to September of 2024. We believe that the government's deficit will continue to rise until state-owned enterprises like Transnet are better managed. The rise in international tourism in South Africa has led to a 12% increase in hotel occupancies. This is a real success story. Particularly, it's a DA success story because they have modified the visa regulations with their control of home affairs. In the fourth quarter, hotel income jumped 24.6%. That's pretty impressive. Accommodation income was up 16.7%, and the unit nights sold rose by 4.5%. Income per night increased by 11.7%. This boosts employment and contributes obviously to GDP growth. Eskom's 12.7% price increase came into effect yesterday on the 1st of April. Poorer households could be paying as much as 37% more. Eskom is penalizing households which use 250 kilowatt hours per month or less. The increase itself is absurd, though, in our view, because coal prices have fallen by more than a third, and 80% of Eskom's power comes from coal-fired power stations, so how they can justify such a big increase is beyond me. All right, let's take a look at Bitcoin. There's lots of people always interested in Bitcoin. Let me get the chart on the screen for you here. All right, here you can see the chart. There's the US election, right? Here's the rise in Bitcoin, which occurred because of euphoria surrounding Trump's re-election and Musk, obviously, as well. We have always repeatedly warned investors not to buy cryptocurrencies, mainly because cryptos have no fundamental value. Their price is based entirely on perceptions, and the only way to judge perceptions is with technical analysis. So what you can see is that the 17th of December proved to be the turning point. So we had a period of euphoria from the election result to the 17th of December. That is the top. And as you can see, since then we've had two more lower tops. So this is what we call a descending triple top. And that is a sure sign that the smart money is dumping, is getting out of this particular thing. You can see the cycle low here was on the 13th of January at $91,847, and that we have subsequently been in a downward trend, and we've seen that low taken out. So we're now down here at about $85,000. We believe that Bitcoin and all cryptocurrencies will continue to fall from this level. So our advice remains the same. If you have it, sell it. If you don't have it, don't buy it. Okay, let's look at a few companies now. I want to begin with ATT. ATT. Didn't get it. Let's try again. ATT. There we go. All right, this is ATT. So ATT is a real estate investment trust. Just putting a bit more data on the screen here so that you can see what's been going on. There was a long period of sideways movement in this company. Obviously, like most real estate investment trusts, it took a hammering in 2020 because of COVID. And it actually reached a low of 300 cents a share, but since then it's been recovering. In its results for the 6 months to the 31st of December, distributable income was up 49.1%. That's quite impressive. What else is impressive about this particular real estate investment trust is that it has a loan to value of 25.9%. That is extremely low. We generally regard any rate or property company with a loan to value of less than 40% to be okay. But 25.9% is very, very good. It means that they've got a lot of headroom in their balance sheet. So you can see in the second half of last year, the share was basically moving sideways, and then it broke up, and we added it to the winning shares list here on the 25th of January 2024 at a price of 964 cents. Since then, it's been in a strong upward trend, and last night it closed at 1,318 cents per share, so sharply up over that period of time. Remember that this is a property company, so it's inherently very secure. It owns the Mall of Africa, and also it's developing Waterfall Estate on the sort of eastern side of Johannesburg, which is a very, very big operation. We believe that this share will continue to gain ground, and it's a very well managed and low risk property share. Okay, and then Southern Sun Hotels, SSU as it's called these days. Obviously this is the hotel side of Tsogosan, which was split off. Put a bit more data on the screen here so that you can see what's going on. It's split off from Tsogosan. What you can see in this chart is that this particular company was moving sideways for a long time until April, around about here, and then it started a new upward trend, which you can see here. We added it to the winning shares list on the 17th of May, which I think is this day here, 16th, 17th. Okay, there. Well, it was on this roughly the 17th of May. It was 555 cents a share, as you can see on the screen. It's now moved up to where it closed last night at 846 cents, which is a gain of about 50%. And we believe it is a very well managed operation and should continue to gain ground as hotel occupancies go up and the economy improves. All right, so that's Southern Sun. Let's look at Premier. Premier, of course, is a food producer. It was spun out of Brait in March 2023. Close that. Let's just go back here a little bit. Right, you can see after a period of sideways movement towards the end of last year, it started a new upward trend. We added it to the winning shares list here on the 21st of August at 76.35 cents. This company basically is a food producer. It operates bakeries, wheat mills, maize mills, and manufacturing plants for food. It produces pasta, biscuits, animal feeds, and all sorts of other food products. Look, food is generally not a great investment, but Premier has broken up out of its sideways pattern, as you can see, and it's now risen to around 130 cents. What is interesting for us is that we had a hammer formation here a couple of days ago on the 28th of March, and we think that it might break above this resistance that you can see here, which is at 130 Rand a share. So we quite like Premier at the moment, but it's also been on the winning shares list for quite a while. Okay, Advotech. We have always liked education shares. Obviously, Advotech provides a wide range of education, starting from maybe 2 years is probably better. Yeah. So you can see that they provide education from preschool all the way up to PhD level, and they've been growing steadily since they obviously were hammered during COVID, as most companies were, but they've been doing well since then. In their results for the year to the 31st of December, revenue was up 8% and headline earnings per share were up 16%. They've got a policy of buying back their own shares, which pushes up the net asset value. Their listed competitors are Curro and obviously Stadio. Here you can see the chart. The shares offer private investors a very steady growth investment. So this is a solid growth share in our view. It was added to the winning shares list, as you can see, on the 14th of August at 1975 cents. It's been on the list for 2 years, and that time it's gone up 64.2%. Its dividends have risen from 15 cents a share in 2019 to last year's dividend of 101 cents. So we expect it to continue to perform well. The next share I want to look at is also in the educational area. That is Stadio. Stadio offers only tertiary or post-matric education, and it has a range of different courses. which are available to people who are post-matric. Customers, of course, pay for education in advance generally. That is the tradition. And that means that companies like Advertech and Stadio, which are in the education business, generally have a very good cash flow, and they have no working capital to speak of. They are quite capital intensive in the sense that they've got to own campuses and colleges and schools and things like that. So that requires an investment into capital. But they don't have a working capital problem with stock and debtors and things like that. Stadio, in its results for the year to the 31st of December, had revenue up 14% and headline earnings per share up 28%. The upward trend began in June last year, and we added it to the winning shares list at the end of June at the price of 525 cents. It's now risen to, what is it now? 752 cents. So that's a gain of about 43% in 9 months. And its dividends have risen from 4.7 cents in 2021 to 15.1 cents last year. So it's a good dividend payer as well. The last share I want to look at is Datatech. Datatech is an international IT company. They're involved in communications and all forms of information technology. They operate in more than 50 countries in America, in South America, in Europe, Africa, the Middle East, and Asia. In their trading update for the year to the 28th of February, they said their gross profit will be up 6% due to increased demand for cybersecurity and cloud infrastructure. The share has been in a strong upward trend. We added it to the winning shares list at 39.50, as you can see there. In October last year, at the end of October last year, it's now 54.45, so it's gone up about 37.8%. We expect this share to continue to perform well, and we recommend that it's a good investment for private investors. Well, folks, that about sums it up. That's what I've got for you today. I hope that you found something of value in that presentation, and I will be back here on the first Wednesday in May. So mark that in your diary. Thank you for listening to me.